By Jim Stanford from Unifor.
Well, hello everyone. And first of all, thank you very much to Kevin and Greg and the Center for Social Justice for this remarkable initiative. It's very ambitious. Not just the scope of the issues around pensions that you're going to explore in the course of your series. It's also remarkably ambitious that you're doing it on Friday afternoon.
On a long weekend.
What else would you do on a sunny Friday afternoon of a long weekend other than come to a politically correct but dark boardroom and talk about pensions? Which shows you we are all sick puppies, aren't we? Yeah.
Oh yeah.
I agree. And I also I thank Greg and Suzanne both for saying they use my book in their teaching, so I'll pay you the kickback, which would be the beer after we're all done. I agreed with everything Suzanne said, and in fact, I could just stand up and say it all again, and that's more or less what I'm going to do. I'll do it in a less elegant way, a more cartoonish way perhaps. In fact, it's so cartoonish, I'm going to use an actual cartoon in the course of, I think, restating more or less exactly the same points. I want to start by describing how I understand the modern economy actually works, okay? How I think capitalism works, how I think firms work, and how I understand the role of finance in that whole system. And that is going to shed a lot of light on how we then start to analyze the issue of the link between finance, financial claims, specific types of financial claims, and the operation of the real economy, that is to say the companies whose actions we often find abhorrent, and rightly so. So this is a cartoon that comes from my book, Economics for Everyone, which uses these illustrations, these kind of roadmaps, done by Tony Biddle. I'm sure some of you must have met Tony. Wonderful guy in Toronto, the most politically astute cartoonist I've ever met. And as we go through the book, he illustrates these different, very simplistic, but I think for a non-technical audience, more understandable description of how capitalism works. Now I'm going to start with the bottom portion of the cartoon, because the bottom portion of the cartoon is what I call the real economy. That is to say, the part of the economy that actually produces goods and services that have some kind of concrete usefulness. Not always under capitalism. Sometimes, guided by the profit motive, they produce things that are useless, or worse yet, destructive. But they are tangible products and services produced through the work of the people who produce them, assisted by the tools that they use in their work, which in turn were produced by other workers and hence are just an indirect form of labor. So, in the bottom part here, we're starting with the rich guy with the cigar and the big mansion in his house, okay, who is our archetypical capitalist, okay? You could say he's kind of like Conrad Black there, okay? But he's not bald, first of all, and there's no iron bars on the house that he's in front of. So he's not Conrad Black. At any rate, Conrad Black's out. Did you notice Conrad Black in the paper the other day? Advocating public ownership of the aerospace and auto industries? That was bizarre. I almost lost my shreddies when I read that one. Huh?
See how time did him some good.
Maybe that's exactly right. Maybe it's there's something kind of Maoist in that, isn't there? You know, put the guy to work busting rocks, doing some real work for a change, and look what it does for his view. Yeah, okay. Okay, so the guy who's not Conrad Black starts the whole system. Okay, and this is what is so obscured in both the traditional neoclassical explanation of how capitalism works, but also many of our critiques of it, which try to emphasize the other good things in the economy, but underestimate the importance and the dependence of the whole system on this guy doing one thing. And that's that letter called I. That letter called I is the investment that the capitalist makes in a real productive enterprise. In this case, it's a factory, but it could be an office, it could be a store, it could be anywhere else where real work is producing real goods and services. By making that investment, purchasing the equipment, setting up the business, paying for the first set of raw materials, paying for the first wages of the workers, he is pressing go on the machine that's called capitalism. Okay? So then, nothing would happen in that, though, if he didn't have workers. He doesn't work, he just owns stuff and spends stuff. Okay? So the workers are there. If you really looked carefully at this, you could say, what the heck are they producing in there? Any guesses? I know it's small. What they're producing in this factory?
Dolls?
Kewpie dolls. Kewpie dolls. Exactly. What kind of Kewpie dolls? Look very closely. Can you tell? They sort of look like chickens, don't they? But no, that's a top hat and a bow tie. They're producing little capitalist dolls. The capitalist action figures is what's being produced here, okay? But again, it doesn't matter what's being produced. The fact is it's workers who are producing it, workers who live in their own households, obviously more modest than the mansion up on the hill where Conrad Black lives. Why do the workers work? Not for the joy of producing capitalist action figures, but for the wages, W, that they receive in return for their efforts. And they immediately give the money back to the capitalist, collectively speaking, in the money that they spend on consumption. That's C. If this was a one-company world, this would mean going back to the company store and spending your wage, which is exactly how it used to happen. Today it's a multi-company world, so you give it back to the collective of capitalists. Sorry?
Well, that's here in New Brunswick when you give it to the urban.
Where there is still a company store and a company gas station.
Company province.
Okay. And company newspapers to get your company flyers to go to the company store. Right. So that there is half of Koletsky's slogan. Workers spend what they get. Okay, they're paid to do the job and then they spend it on consumption. And in essence, that's what workers do over their life cycle. Workers do not accumulate. Workers do spend what they get. The net lifetime saving of the working class is zero. And this is very evident in the economic data that we have. And that is a fundamental point that's obscured by much of the socially responsible investment literature. After he's paid the costs of the wages and all the other costs, the capitalist gets some money, and that's the sign which has the Greek letter pi there, which in economics for some reason is the symbol for profit in economics. I've always wondered why, but actually after Tony drew this cartoon I figured it out. Look at the capitalist's faux Greek mansion there. You see the pillars and this front door? That actually is the Greek letter pi there, so you see it. That explains it. The capitalist spends a bit of money on his own consumption. If he's an American capitalist, he spends it all on his own consumption. If he's a Chinese capitalist, he spends a small slice of his own consumption and funnels the rest back in new investment in his
I is also an infinite number.
I is an infinite number. Oh yes, in math. Right. Yeah, it can be an infinite number or it can be an infinitesimal number as well, which is the case in Canada these days. That little cycle there, from the capitalist to the workplace, the working class households, the profit that comes back to the capitalist. That is a very simple description of the cycle of investment, production, consumption, and profit that is the core of capitalism. And it all starts with him making that initial investment. This describes actually about 85% of Canada's economy, where 85% of our GDP is produced in for-profit enterprises. Now, this leaves the question, where did the capitalists get the money to make that initial investment from? Okay? Well, it can come from many places. He could have stolen it. That's how it usually happens in the beginning of capitalism. He could be using his own savings generated by his existing business. That's more or less what happens today. Or, if he's a growing business and has additional needs over and above his current cash flow, he goes to the financial sector. And that's where this part of the graph comes in. Okay, you have some banks, you have Bay Street, Wall Street, the city, whatever you want to call it, up on the top, glorious high rises. In theory, these institutions play a productive purpose. They are supposed to create purchasing power to allow the capitalists to finance that initial investment in real production. In practice, the financial sector becomes a world unto itself. Okay, it becomes the tail that wags the dog, in essence, and it becomes a site of profit in and of itself. Not productive profit, because there's nothing produced up here, right? But speculative profit, in essence, or a way of capturing some of the profit that is produced from production. In the simplest form, on this map, imagine that these are banks, and the banks give a loan marked D for debt to the capitalist to help pay for that initial investment. Do you see that? So they've created purchasing power to start the whole process. Then once the profit is generated in production, not within the bank gets its cut. The bank gets its cut, which is some of the profit going back to the capitalist is now siphoned off to the bank to repay the debt, and as well as interest or profit or dividends or something else on the initial loan that was made. The important thing to remember about banks, as Suzanne has already said, we operate in a private credit money system, which means banks have been given the license to create money out of thin air, and they literally do create money out of thin air every time they issue a new loan. And this is another thing that is not well understood. In the more complex world of corporate finance today, it is not just bank loans. In fact, bank loans are one of the least preferred ways for a company to finance its business when it needs to. You have all kinds of more complex and flexible structures for creating that initial purchasing power, like bonds, shares, preferred shares, and all kinds of other exotic ways of delivering the purchasing power from the financial sector to the capitalist. But it's ultimately all driven by the same thing: the power of the financial sector to create money out of thin air, directly or indirectly, through its credit creating process. Important implications to having finance at the top of this picture now. One of them is the system is no longer constrained by the real savings of anyone down here in the productive sphere. If you want to undertake an investment, you no longer have to pinch your pennies and be a prudent homemaker and put money in a jar and then use it to finance something. You can finance it out of credit created out of thin air. The system is not productive in its own right, but it does, in the best case, facilitate production, and it creates a potential division, if you like, between the capitalist and the financier over the division of the fruits of that production. In addition, because they're so clever, the financiers have created all kinds of secondary markets, different ways to take advantage of an opportunity for profit making, particularly speculative profit. Speculative profit means you bought low and sold high. You haven't produced anything. You bought something and sold it for a profit. That's speculation. Unless you're a short seller, in which case you buy high and sell low and make a profit that way because of your clever use of derivatives. And all of the exotic financial markets, such as bond markets, stock markets, derivative markets, have all been created by financiers who, in one way or another, are betting on changes in the price of different paper assets that were created in the system. And that opens up a huge amount of activity, first of all, a huge amount of opportunity. It allows them to capture more of the flow of real profits that's generated in the economy. In America, before the meltdown, half of the whole economy's profits were captured within the financial sphere of the economy. Canada was never that bad. It was about a quarter at peak, but still an enormous diversion of the surplus from the actual real production that's occurring. Because of those secondary markets, it's very important to remember you aren't hurting a capitalist when you don't buy his shares. Mm-hmm. This is another point that's totally misunderstood in the socially responsible investing community. Once the shares have been issued, yes, the capitalist got the purchasing power and used it to finance some investment, but that's not what 99% of the activity on the stock market is about. In fact, nowadays, because there's almost no new issues of equity, it's about 100% of the activity on the stock market is buying and reselling and rebuying and reselling pieces of paper that have already been issued. You do not starve the company of capital when you don't buy its shares. Similarly, you don't reward a good company when you do buy its shares, because of the distant relationship between that secondary financial trading driven by speculative motives and the real process of production that's at the bottom of the graph. The whole trend to financialization, which has characterized capitalism, including Canada, particularly the Anglo-Saxon varieties, but more generally as well, has been the overdevelopment of this part of the graph. So there's more activity, there's more power, there's more prestige, there's more profit, there's more influence on the financial sphere at the top of the graph. But lots of problems with financialization. It's inherently wasteful. We're taking some of the smartest people in the world and putting them to do something that's fundamentally unproductive at best, destructive at worst. It's destabilizing because of the complex ways that all of those secondary markets interact with each other. and the potential for spillover of a downturn in any of those markets. If it was purely a self-contained casino out there, I'd say go for it. Go waste all your money, I don't care. But it isn't, because it spills over into consumer confidence, consumer spending, and the activity of the real investors who are actually the ones who drive capitalism. It's also profoundly unfair. The ownership of financial capital, when you think about it, this shouldn't be surprising, is incredibly concentrated in the wealthiest families in the land. And there's a whole mythology that the financial industry has helped to promote, that we can all play the markets, that we all have a stake in it. And of course you can. We can all go out and buy one share of the Royal Bank, but that doesn't make us capitalists. It makes us bit players. And the concentration of wealth is very badly documented, in part because our statistics are so bad. But the evidence is clear that at least a third of all net financial wealth is owned by the richest 1% of the population. Over half is owned by the richest 5% of the population. The bottom 50% of the population owns zero wealth because workers spend what they get. Now that's my depiction of how the system works. How does that relate to the whole theory of socially responsible investment? Their claim is that average people can use their little piece of ownership of the financial wealth of the company, that is their stake in the top part of the map, to influence the conditions and activities in the bottom part of the map, particularly with a goal to improving labor standards, environmental performance, and other ethical issues. That claim over the wealth can come in different ways. It could come from pensions that we're talking about today. It could also represent individual wealth, and we've seen this ethical mutual fund industry and so on. Another form was these labor-sponsored venture capital funds, which in a way are a different beast, and I'm not going to talk about them too much in the presentation. They were a complete boondoggle. They were very strongly criticized, and now they're mostly defunct. So that's one of those cases where we can totally say, I told you so, not that it makes you feel any better, because a lot of average working people who thought they were doing something good got totally burned by it all. There are many problems with the idea that you can wield a piece of ownership, either individually or collectively, to direct companies to do things that they wouldn't do otherwise if they were guided by profitability alone. Let me quickly list 10 of them. Number one, it's like a David Letterman list. And since I have 5 minutes, that's 30 seconds each. Pensions don't actually own that much of the finance that's there. In Canada, they own about 10% of all corporate equities are in pension funds, collectively managed pension funds. So what about the other 90%? And that share is shrinking because pension coverage is shrinking, which is a big problem in society that we need to fight against. Number two, it promotes a mythology that ownership itself can be democratic. The $1, one vote, or one share, one vote vision of democracy that Suzanne rightly criticized. Number three, it promotes a mythology that financial processes are somehow real or productive or efficient, when in fact we should be fundamentally challenging the doctrine of financialization and the myth that these people up here are actually controlling the strings of the real economy, as opposed to buying and selling pieces of paper. Number four, this is one that really burns my ass, to use the technical term in economics. We should, as popular educators, we should define our terms as we go along. Burns my ass is a technical term that means generates profound negative inclinations. It generates profound negative inclinations for me how the socially responsible investment literature legitimates wealth, the ownership of wealth, and the collection of profits from the ownership of wealth, including through the false claim that there's no trade-off between ethics and profits. That's a very common claim that you see in the literature and the ethical mutual funds and elsewhere. They forget profit is a surplus that's extracted from the process of real production down here at the bottom of the cartoon through pure social relationships. There's nothing productive about capital in that sense of it. And the SRI movement is disguising that fundamental fact by trying to say that as long as you behave ethically, then it's quite fine to extract as much profit from your investments as you can. Number five, a related point, is that it constructs citizenship as ownership and therefore harkens back to the days when democracy was for the owners of property, really. Number six, it pretends that you can prevent a bad company from doing bad things by starving it of capital. And that's absolutely false. And I honestly don't think that has ever occurred in history. The financial system is so flexible that if it's not a bank, if it's not one bank, it's another bank. If it's not that bank, it's an investment bank. If it's not that bank, it's a group of preferred shareholders. If the activity that the company is doing is profitable, doesn't matter if it's ethical, if it's profitable, it will never be starved of finance to allow it to do that activity, because the system is so flexible, it will find ways to create credit to provide the capital that the company needs. Number 7, in the world of pensions, it opens up a potential conflict with pension fund members, because their benefits in one way or another would be affected if a social mandate for a pension fund was taken seriously rather than symbolically. And that raises a question: why should workers accept constraints on that 10% that they own through their pension funds, whereas the 90% of greedy bastard capital doesn't face any constraints? Number 8, Suzanne put this one very well. It can distract us from other ultimately more important ways of regulating corporate behavior as citizens and as workers rather than as investors, like fighting for regulation. And companies are explicit that they view the whole social responsible thing as a way of preempting calls for actual binding regulation. They're very clear on that. Number 9, most of the social responsible initiatives completely ignore the terrain of domestic labor relations here in Canada. I've never seen a socially responsible firm target for censure a company that was mistreating or busting unions or doing something else to Canadian workers here in Canada. It's always about the poor people in the South, okay, or the environment, or maybe ethical issues like tobacco, but they never, even the labor-sponsored venture capital funds in English Canada, the Solidarity Fund was different in Quebec, but in English Canada they were explicit. We will make no interference whatsoever in how you conduct your business if we buy some of your shares. And number 10 is the cannibalistic capitalism, a wonderful moniker that Suzanne talked about, which is this whole idea of activist investors and stronger corporate governments has actually backfired, because it has pushed companies to focus more ruthlessly on cost-cutting and short-term profit generation. How do we stop companies from doing bad things? We have to make it illegal or prohibited through legal change or regulation. Or we can make it unprofitable. They will stop doing it if it's unprofitable. To some extent, we can stop it by making it socially unacceptable. And this is where I think I've mellowed a bit in my old age. I think the broader corporate social responsibility movement, as opposed to the SRI initiative in particular, has had some impact in terms of exposing what, and in a way shifting the goalposts in cultural terms about what's acceptable and what isn't. And I don't write it off entirely, like I once did. I think public pressure, public censure, public disapproval can undermine the social license which intelligent capitalists know they need. Okay? Intelligent capitalists know that their ability to function as they do does depend on the ultimate legitimacy of their institution. And that can be thrown into jeopardy. Look at the Royal Bank and the furor over the temporary foreign workers. And they made a big change in how they deal with that issue as a result of that. That wasn't socially responsible investment, right? But that was public pressure, consumer boycotts, backlash, in a way a cultural expression of opposition of what they're doing. Opposition to what they're doing. My strategy for social change, number 1, we must fundamentally critique financialization in all of its forms for its waste and its unfairness. Number 2, we must fight for public pensions that are delivered through the state, deliberately taking a share of the real output of society and giving it to our older people, and sidestep financialization altogether. The best thing about the old age security system is there's no financialization at all. The CPP has almost no financialization. There is this reserve fund, but most of the CPP is a pay-as-you-go fund that sidesteps Bay Street altogether. Number 3, we should fight to change corporate behavior through regulation and law and binding reforms. And number 4, in the long run, if we want to win genuine control over capital, then we'll have to socialize it someday, which is a very different project than what the SRI hopes.